Charlie, what are we looking for? Just a little mini preview on the banks. It's the holiday week. You get a little time. Like, what are we looking for as we come closer to the banks kicking off earnings?
The big banks start reporting July 14th. JPMorgan sort of starts the whole process and sets the tone for everybody. And they're going to, all the banks are going to report really strong second quarter earnings. It's going to be double-digit, EPS growth. The results are going to be very positive. But, everything changed on the 17th of June when Warsh came out with his hawkish rhetoric on rates. And so the yield curve is flattened dramatically. I think we're around 30 basis points between 2s and 10s. We had been as wide as 70 basis points back in February. So I'm going to be more interested in the commentary about the second half. There are two things that you're going to want to listen to. What impact is the flattening of the yield curve have on net interest income forecast for the second half of the year? And then secondly, as you mentioned, Ben, the debt spread widening trade is going to have an impact on capital markets. And, there is tremendous optimism about the pipeline of capital markets activities priced into these stocks. But again, everything has changed in the last week or two on the capital markets front as we've seen disappointment in IPOs in terms of their secondary price action and debt issuances. There's only so much this negative secondary price action that portfolio managers are going to accept before they say no mas with respect to future issuances. So, that secondary price action, which has not been good, is going to have a big impact on the confidence of portfolio managers to continue to fuel this pipeline of expected activity. I think the potential big losers there are going to be private equity and private credit. I continue to think they are the epicenter of the next credit crisis, and they are the equivalent of, the trust companies back in 1907, the panic of 1907. And, we wrote about this weekend. I'm getting off on tangents here, so stop me if I get too far afield. But Apollo has come out with a new product called AMAPS, AMAPS. And it basically is a new product that is going to replace their CLOs because the regulators led by Scott Bessent and the insurance regulators have been criticizing the insurance company for the risks they're taking on their balance sheets. And so, something like Athene, which is owned by Apollo, had, I think it was about 33% of their balance sheet in CLOs. And so they're trying to run those down, and they're replacing it with this thing called AMAPS. Well, AMAPS literally removes the investor 3 layers from what they're actually eventually investing in. I'm not going to go into the details of the structure, but it basically layers investments upon investments. So you really don't know what you're investing in at the end of the day if you're the end investor. And this opaqueness and obscurity of what they're trying to do is what's gotten them into trouble in terms of their multiple devaluations or derating of their stock. And so I think sometimes Wall Street can be too clever for their own good, as they were back in 2007, 2008. And I think what we're going to hear, going back to your question in the second quarter earnings, good reports, but concerns about the second half. And I think, the concerns are going to continue to mount for these private equity, private credit groups, as reflected in the redemptions that keep coming. Bottom line of all of that is, I've written about this, but PPNR, which is pre-tax, pre-provision net revenues, the change in rate of growth has the best correlation with bank stock prices.